If your fair value gap entries keep getting stopped out, the problem may not be the FVG, it's that you don't know when an FVG is about to fail and turn into an IFVG. Master this shift, and you'll start seeing cleaner, higher probability entries. Before we start today's video, if you'd like to receive offers on courses, exclusive tools and indicators from Rober, as well as market information and signals for gold and Forex, you can join the community via link pinned in video description. And of course, everything is completely free. From what I've seen, both in the UK and overseas, a lot of traders are interested in this method and are trying to apply it. Have you ever seen price bounce from an empty price area on the chart? Or asked yourself why price often comes back to fill the gap before continuing in the same direction? In this video, I'm going to help you understand two concepts: FVG, which stands for Fair Value Gap, and IFVG, which stands for Inversion Fair Value Gap. These concepts can help you catch potential tops and bottoms or understand how far price may retrace before continuing in the previous trend. Before we start, if you'd like to receive offers on courses, exclusive tools and indicators from Rober, as well as market information and signals for gold and Forex, you can join the community via the link pinned in the video description. And of course, everything is completely free. First, let's look at FVG. An FVG is a price gap created when a strong move causes the market to shift and become volatile, whilst buyers and sellers are unable to match their orders quickly enough. It represents an imbalance between supply and demand and will often be filled, meaning price comes back to fill the previous empty price area before potentially continuing in the original direction. There are several basic rules for an FVG. The first candle closes at a certain price. The second candle creates a large body with little to almost no wick. The third candle does not touch the body of the first candle. FVG can be divided into two types: bullish FVG and bearish FVG. A bullish FVG appears within an uptrend and is formed by three candles. The middle candle has a large and strong body, creating a price gap between the high of the first candle and the low of the third candle. This is the FVG zone. Within an uptrend, it often acts as support, where price tends to return to fill the gap before continuing higher. A bearish FVG appears within a downtrend when the market makes a strong downward move. It is also formed by three candles, with the middle candle normally being a long bearish candle. This creates a gap between the low of the first candle and the high of the third candle, representing an imbalance where sellers have the advantage. The bearish FVG can act as resistance, and price will often return to test this zone before continuing lower. Now let's see how to recognize these FVGs on an actual chart. For a bullish FVG, first identify the base candle, then observe the second candle. If it is a strong bullish candle with a large body and very little or no wick, it meets the condition. Next, the lowest price of the third candle must be higher than the highest price of the first candle. We then mark the gap between candle 1 and candle 3 as the FVG zone. This is the area to watch when price comes back. Similarly, for a bearish FVG, first find the base candle. The second candle must be a strong bearish candle with a large body and very little wick. The highest price of the third candle must then be lower than the lowest price of the first candle. This creates a gap between the first and third candles. That is the FVG. There are a few points to keep in mind. First, not every FVG will be completely filled. An unfilled FVG can indicate a strong trend because the market can maintain its momentum without returning for a correction. Second, FVGs on higher time frames such as H1, H4, and D1 generally carry more significance and tend to be more reliable than those on M5 or M15. You should also practice identifying FVGs on historical charts to understand how price reacts around these areas. Now we understand both bullish FVG and bearish FVG. Another related concept is IFVG. An inversion fair value gap occurs when an FVG is broken through and then becomes an opposite resistance or support zone. An IFVG often appears around a liquidity sweep or market structure shift, representing a change in market psychology. Just like FVG, IFVG can be bullish or bearish. For a bullish IFVG, first identify a bearish FVG. When price fills the gap and closes above the entire FVG zone, it becomes a bullish IFVG and acts as support, showing that sellers are weakening and momentum is shifting towards the buyers. For a bearish IFVG, price closes below the entire bullish FVG instead of bouncing from it. The previous bullish FVG is no longer support and becomes resistance, signaling that buyers are weakening and a reversal or continuation of the downtrend may occur. To identify an IFVG, first find an FVG zone. Second, monitor whether price breaks through it. Third, if price breaks through and comes back to retest it from the opposite side, that becomes an IFVG. Now, how do we trade with FVG and IFVG? Let's start with FVG. Step 1 is identifying the market trend. In an uptrend, price creates higher highs and higher lows. In a downtrend, price creates lower highs and lower lows. Step 2 is identifying the premium and discount zones. In a downtrend, look for an FVG within the premium zone for a potential sell. In an uptrend, look for an FVG within the discount zone for a potential buy. Once you've identified the trend, look for a candle with a large body and a very small wick, showing aggressive movement in one direction. Step 4. Observe the candles before and after it. Their candle bodies should not overlap with the middle candle, creating an FVG between the wicks of the first and third candles. Step 5 is marking the FVG zone. In an uptrend, it is between the high of the first candle and the low of the third candle. In a downtrend, it is between the low of the first candle and the high of the third candle. In an uptrend, wait for price to retest the discount FVG. When there is price rejection or a shift in market structure on a lower time frame, we can consider a buy. After an MSS appears, an imbalanced candle with a large body and very little wick creates an FVG. When price retests the FVG and is rejected, we can buy, place the stop loss below the FVG, and set the TP around the previous high. Conversely, in a downtrend, wait for price to retrace into the premium FVG. If a reversal or rejection signal appears, consider a sell. In this example, Bitcoin breaks the rising trend line and creates an MSS. A long-bodied candle with very little wick creates a bearish FVG. We can sell around the FVG when we see rejection signals such as pin bars, engulfing candles, or rejection wicks. We place the stop loss above the FVG zone and set the TP at least at the previous low. Now that we've covered FVG, let's move on to how to trade with IFVG. Step 1. Identify the FVG that has been broken. Once broken, it becomes an IFVG. Step 2. Wait for price to come back and retest the IFVG from the opposite side. Step 3. Look for confirmation signals, such as price rejection and a BOS or MSS confirming a new trend. Step 4. Enter in the direction of the new trend. With a bearish IFVG, we sell when price comes back to retest the zone. With a bullish IFVG, we buy when price comes back to retest the zone. Step 5. Place the stop loss and TP in a similar way to the FVG strategy. In the first example, price moves lower and creates a bearish FVG. And I'll see you again in the next video, where we'll continue exploring more elements within the ICT system. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.